Investment banking and brokerage, but the financial business, I would say especially investment banking, it's not a part-time business. You've got to be there full-time, flat out all the time. Because the clients, when they call, they want you to be there. And they want you to be knowledgeable and supportive and so on. We used to say that at our annual meetings almost every year to remind people that, we are a partnership and we all get along well together. But yes, it's not a family, it is a team, and you have to try out every year, and either you make the cut or you don't. And so you have to be, in a nice sort of way, pretty ruthless about how you run a business like this. Because if you don't have the best people, you're not going to survive. And countless firms have found that out. So you have to constantly focus on upgrading your staff, which we did. And I think that it's been a very, as I say, a successful venture. If you look at the 40-odd year record of the firm, it's worked out far better than any of us ever anticipated, of course. A lot of this success in business is all about being in the right place at the right time, and it's all about having good luck. But you have to be very disciplined, and that's why I really enjoyed the meeting started off at 7:30 or quarter day. We finally moved them up to 7 o'clock. And it was a good discipline from the point of view at those meetings. Every morning we would review the financial results of the past day. We knew exactly how much money we made or lost the morning after the day. And we went through it by division of the firm. So the brokerage division, investment banking division, trading division, and so on. And if they lost money, the head of that group would have to say what happened. And we congratulate people who had a good week or a good month, but those who didn't, had to account for it, which I think is a good discipline. And it's one that is appreciated by people. Part of our success, I think, related to good communication through the firm. Everybody was kept up to date on how we were doing, whether there were problems or wins or losses. Everybody knew what was going on. Everybody knew what the focus was and what our long-term objective was. That went down a long way, not to the executive assistants and so on, but certainly all the partners, we had quite a few shareholders. All the shareholders would know what was going on. And that's why we had, at our annual meetings, we went through an exhaustive report by division of what happened in the past year. And I think the other thing that we had, it was a very clear vision. We wanted to make a 25% return on our equity after tax. And the reason we picked that number, and that number was picked in 1973 when we merged with Harris, was the number, the profitability we had to achieve to pay our bank loan interest, because we'd all borrowed money to buy into the firm, to pay our bank loan interest, to pay our loans off, hopefully over 10 or 15 years, and at the same time keep enough money in the business to build our capital. We figured we had to make a 25% return on equity. And it's quite interesting. If you go back over the 40-odd years, we've averaged about 23%. It was in the early years, it was higher, like in the 80s. Not so much in the 70s, because that was tough, but in the 80s and 90s, we had some very profitable years where our returns were up around 35%. It's lower now because of the increased capital requirements we're required to have as a result of the financial meltdown in 2007, 2008. New regulation, OSFI has brought in a whole range of new regulations, as you know. The Basel requirements out of Switzerland were all implemented. And roughly now, to do the same amount of business as we were doing, we have to have twice as much capital. So that if you were earning 28%, you'd now be earning 14%. And our firm recently has been earning in the 13, 14% area, which when you consider that long Canada bonds are yielding around 2%, is still a very profitable business. It's just not quite as profitable as it was. The business has changed, but the capital requirements have escalated dramatically, which I think is a good thing because there's more stability in the business now. Firms are able to withstand shocks that we couldn't have withstood going back 20 and 30 years because of these capital requirements. I mean, we have a very large share of the Canadian market, but we reached a point of diminishing returns. You're never going to have 50% of the market. We got up to maybe 25 and 30%, which is about the maximum you're going to get. So we had to go outside of Canada. And it was rough going from 2000 to 2005, 2007. We found it difficult in the international markets. But in the last 10 years, it's been terrific. The U.S. markets have been strong, and we've been able to grow our business. We're now about the 10th largest dealer in the U.S., which is quite something in such a short period of time. I think it's fair to say that the business has more stability now, not only because we have more capital, but the firms are much bigger and far more diversified. I mean, if you look at Dominion, RBC Capital Markets now, I'd say virtually half or more of our business is in the United States. And the real growth of our firm in the last 10 or 15 years has been outside of Canada. But the one good thing about the investment banking business, not so much now, but in the years I was in it actively, was that one time you'd be working with an oil and gas company, another time you'd be working with a hydroelectric company, or a mining company, or a Loblaws, or whatever it might be. You got a full range. Now it's more specialized. I mean, we have bankers who are interested, spend their whole time on the oil and gas business or on the mining business. They don't see the broad spectrum like we did. The bank gave us remarkable freedom. And our view has always been, it's a cyclical business, right? And our view was always that you should be able to make a little bit of money even in severe downturn. But in good time, you should be able to make a lot of money. So that the average was positive, very good. And we still have that culture.